From a geopolitical perspective, there are several potential sources of volatility going into 2025, including US-China relations, the ongoing Russia-Ukraine conflict, instability in the Middle East, and a rise in nationalism and populism in various countries. The trajectories of interest rates and inflation will also continue to play a crucial role in shaping equity markets, and growing concerns over global debt levels are likely to remain in focus. Additionally, the incoming Trump administration in the US introduces another layer of uncertainty, as investors will need to evaluate the possible effects of changes in trade policies, tariffs, and immigration, along with the potential benefits of fiscal stimulus and deregulation. So the incoming Trump administration may also prevent some very specific challenges to infrastructure. For example, we expect that this new administration will seek to repeal some of the provisions of the Biden administration's historically relevant climate legislation, the Inflation Reduction Act of 2022. However, our base case is that tax credits supporting onshore wind and solar investment, the most meaningful aspect of the legislation for listed infrastructure companies, will remain in place. These policies have been around for a long time and benefit from broad bipartisan support, and we believe the energy transition will continue to be an investable theme for decades to come. We also note that President-elect Trump's corporate tax cut proposals may have varying impacts for the listed infrastructure companies. It may actually be a headwind for some US utilities, as was the case in the first Trump administration, when the Tax Cut and Jobs Act of 2017 was widely cited as a credit negative for the US utility sector.
Look, we've got to acknowledge that there is some regulatory uncertainty as we go into 2025. That really is going to likely create some volatility and perhaps a slow launch to the new year in terms of transaction activity. Look, on the headwind side, it's probably around tariffs and the potential impact of tariffs in the US. And then questions around the sustainability of the renewable incentives. In terms of other challenges, look, paths to exit remain a challenge. And I think this is more of an issue at the larger scale end of the market. But we saw a relatively slow M&A environment in 2024. And hopefully we'll see that improve this year, but it still remains to be seen. Again, I think as the administration, the new administration looks to reduce some of the regulatory burden, hopefully that will accelerate deal making. It may create more opportunities for some of these large infrastructure funds to actually look to exit some of the transactions that they did pre-COVID. Right now, that's a little bit of an impediment to fundraising. And that really gets to the third point, which is fundraising. We expected 2024 to be a rebound year. It wasn't. Will 2025 be a rebound year? I think is one of the big questions. And in my mind, that's going to be driven in a large part by returning capital to investors, which really comes back to, in full circle, back to this question around does the M&A environment pick up?
One of the main remaining challenges in my mind continue to be the lack of pre-development capital that is available to those independent developers to advance the supporting infrastructure project to a stage where institutional investor can come in. You need a team to be able to do all that early work that is really risky to get it to a place where we can invest. And those independent developers are lacking the capital to actually do the work that is required for the project to develop. But what we're seeing, and that's very encouraging, is because of that new need for industrial reshoring, those industrial off-takers are more and more willing to provide that early stage capital to those developers. And so that's an important missing link to make the ecosystem being very sustainable and viable. And so that's very encouraging for us.
The industry, specifically in utility scale solar, is very much centered around de-risking all the procurement issues related with the industry. Specifically, the domestic content adder for the investment tax credits is a huge inducement for all of us to go out there and build fields that meet the criteria. And right now, there's just not enough supply. There's not enough folks and there's not enough supply. And we don't anticipate a lot of that domestic supply, domestic content to really come on anytime soon. So it's more important now than ever to go and make sure that you are either safe harbored or you're diversifying your procurement to make sure that you get to where you need to be in 2026.
For listed infrastructure businesses, capital investment in 2025 is going to play a crucial role in driving future cash flow and earnings growth, as it has in prior years. This is especially true in sectors like energy, where investments to meet rising power demand and support the energy transition require careful and coordinated planning. This planning process involves numerous stakeholders, including regulators, policymakers, politicians, companies, and capital market participants. So because of these complex and long-term planning efforts, investors typically have a high degree of visibility into the future capital investment needs, often with projections extending for 5 to 10 years, particularly in the more highly regulated sectors. So we expect the stable earnings and cash flow growth that infrastructure companies offer will look increasingly appealing to investors as earnings growth in the more economically sensitive parts of the market slows down. And with some lingering geopolitical and macro unknowns that could lead to further market volatility in 2025, these more defensive asset characteristics can offer valuable protection in a portfolio.
Okay, I think first and foremost, it's the digital sector. 2024 was about increasing understanding of the amount of capital required that is going to be needed to build out data centers and all the supporting infrastructure that goes into that. But it's also the power needs and potentially the water needs in that sector as well. So there is a significant amount of capital that people have already announced is going to go into the sector over the next 5 years, and we're continuing to see more need and more development needed. And that's not only at the hyperscale end, where I think there's been quite a significant focus in the course of the last 2 or 3 years, but it's going to become more around making sure that there's data centers that are close to markets, reducing latency, putting data in a position and where AI models can actually run inference support for demand and for questions from retail customers and the consumer. And I think that is going to create a significant next wave of investment in that space. And then look on the tailwinds or the benefits for the market. We actually see the potential for reduced regulatory burden, potentially faster approvals of new deals as they go through some of the approval processes. And then potentially as well, there could be quite some support for further investment in the US in the digital space in particular, but around manufacturing, around transportation to support reshoring, et cetera.
Construction costs after several years of significant increases and volatility are becoming more stable. That means that you can get good visibility on the cost of your new infrastructure, and your schedule, which will again increase the potential for the project to be financeable by institutional investors. And also the current push for streamlining regulatory approvals is also extremely positive for those type of projects.
I probably suggest that one trend that we keep an eye on is the autonomous vehicles and the impact that this could have in the sector. We are optimistic in that sense. We think that it's something that at the end of the day, it could bring even more traffic, because probably we could see more trips, right? So the key challenge there is of course, to keep an eye on the trend and to be able to adapt your infrastructure for that, right? And this is something that our people from innovation, of course, is following closely, and it could be an interesting trend for this year.
I think that in 2025, we're going to see an enormous productivity increase in EPC and construction timelines. Right now, a lot of companies seem to be staffing up really well, and there's a host of new technologies, largely on the construction side. In addition, a lot of the supply chain issues that's centered around getting kind of the very high-end electrical equipment to where it needs to be seems to be getting resolved much quicker. So there's just a lot more stuff out there. And so now things like getting your interconnect on time, making sure that you don't blow timing or all that seem to be easing far more so than 2024.